I can safely say I haven't paid for a flight or a hotel in over 10 years, and there's no need to. We're getting concrete proof of concept, phenomenal returns, and the simplest low stress possible manner.
I think what we're going to talk about here is good because it is so much more important than just earning a rate of return. There is no better opportunity than buying at the bottom. Everybody knows that and nobody does it. But if you're prepared, that's one of the places that I'm going to have capital on the sideline, because when that happens,
Hey everybody, welcome back to Remnant Finance. It is mid-January right now, so already seems like the singular holiday season of December is long past, and we're off and kicking in the new year. I just got back from a little staycation this week. We did Sunday to Thursday at a resort in Pacific Beach here in San Diego, and just got some credit card rewards to burn. So it was really cool for 4 nights. Ended up paying all told, like all meals, hotel, parking, everything together at a nice resort here right on the beach. It was under $200 a day for food, lodging, everything. So I'm a big fan of optimizing credit card rewards. And if you're active duty and you're not doing that, you are leaving a lot of value on the table, which, like Brian acknowledges, he's okay with that because he wants the simplicity. But if you're okay with managing credit cards, understand the value and the power of these travel rewards. I mean, I can safely say I haven't paid for a flight or a hotel in over 10 years, and there's no need to. If you are active duty, you can get these fees waived. You just need to be strategic in the order you open them. But that's like a whole separate conversation that I always love talking through, but not the intention today.
well, it is a good one though. But looking at simplicity versus optimization, and it really, I think it's just a mindset thing. Like you and I are very different in that you are very, very detail in the weeds oriented, and I'm a pretty big picture, like, here's an idea, let's run with this kind of person, or how can I create less stress, more simplicity, and less noise in my life. So to me, it's noise, and that's the other thing, is that noise is subjective. Like, you enjoy, optimizing that and getting down into the weeds on things. And for me, like, credit card wise, I primarily use two. I get a 5% back on Amazon because we spend so much on Amazon. And then I get a 2% back on my other card on everything we do. I take that cash, I put it into my brokerage account. I don't want to have 7 cards for 7 different types of spending to try to get points everywhere. That's just too much in my life. Two is the most I want to handle. And I'm cool with just getting what I get from that. It's just the way my mind works, and I don't want more. But yeah, man, if you can optimize it, and you enjoy doing that, you can really kick some butt.
I think that would be a good little, if there's interest in it. I have had several people ask me before, like, to sit down and go through that process, but I think that would be a good little, maybe just a group call for people that are interested, primarily for militaries, where it's super powerful because you get the annual fees waived. But the order that you do it in, like, I don't worry too much about gas goes on this card, groceries on this card. Right now, I pretty much put most things on my Gemini Bitcoin card because you're getting 3% Bitcoin on all dining there. But the main thing is getting the bonuses, the sign up bonuses, which you put all your spending that you don't spend anymore. You just do your normal spending for your family on one card until you meet that minimum, typically 3 or 6 months, and then you get a huge bonus of points, or whatever the reward is for that card. And then you open another one, and the whole time you're building, like, you're improving your credit by doing this. You're not paying annual fees if you're military, and you're accumulating. I mean, I have mountains of points and miles, and you get, the top tier status with hotels and airlines, and free nights with different hotels. So, and I just bought a roll of silver and got $750 off of that price just because I had to use some money on a card to spend it before January 19th. And so, there's a lot of really cool things you can do. If there actually is interest in doing that, I'd be happy to just hop on a Zoom call with a couple guys and kind of walk through how to do this. And it really is powerful. But anyways, that's totally not what we're talking about today. We are going to talk about growth, though. We're going to talk about investing. We're gonna bring back low stress trading into the conversation. It's something that we talked about a lot towards the end of the year, in the fall and going into November, December, we hit it heavily. A lot of our audience, a lot of our clients are doing it now with great success. So we want to revisit it, and we want to address a few questions that have come up um, specifically that we get asked. Now we have a chat group of clients that are all trading, and um, we'll go through some of their their what's the word, testimonials. It's like their experience so far. But I mean, our group is knocking it out of the park, and so I want to encourage you to explore this as a strategy if you haven't already, because we're getting concrete proof of concept, phenomenal returns, and the simplest low stress possible manner. But we want to mainly focus on kind of three general questions. All of this comes back to the protect, save, grow framework in that order of operations. The first one is how do IBC and low stress trading integrate? How can you use them together? The second is, if you are doing that, what's the order of operations? Do we fund trading first and use that to pay premium? Do we pay premium first and use that to capitalize our brokerage account for the trading? And then the third is addressing that discussion that Brian mentioned last week, where a client was interested in doing IBC, starting to go down that path, then listened to our episode with Troy, the creator of low stress trading, and was like, well, why would I not just do this? And Brian eventually told him, was like, hey, if this is your focus, it makes sense for you to just do low stress trading. IBC is not for you right now. And that's a totally acceptable answer. However, I would like to dive in a little bit more on where that might be a little short-sighted when we bring it back to the protect, save, grow framework. So that's my opening on what we want to cover today. Anything else we want to hit on, Brian, or you want to just jump into like, how do these two things integrate?
Oh yeah, I mean, I think, and I agree with you, but like I often say is I'm not in the convincing business. And
Yeah.
when that person learned low stress trading, or learned about it, it was kind of just like a switch had flipped in that person's brain, and they were like, well, why wouldn't I just do this? Like, why would I do something that is like slowly building and not getting a rate of return? And when I talked about it, you could almost just see the glaze over the eyes of yeah, this is too exciting and too sexy, and why would I want to do slow, boring, build a capital base, et cetera, et cetera, et cetera. And I'm not it's not the end of the world for me either way. So while I disagreed with his assessment, it's not my place to try to tell somebody what to do, right? So um yeah, I think what we're going to talk about here is good because it is so much more important than just earning a rate of return. And the amplification, which we'll show later in this episode, and I'll show it on my screen, of how you can do both and why that's so powerful, is important too. How these two integrate together, I think, is something that a lot of people miss, especially when we live in a world that is just so rate of return oriented, and it's all you hear and it's all you think about. But when you can integrate the capital that you've saved and preserved and that grows anyway and provides protection with the rate of return, both boats, um, all boats rise. It's
Yeah.
phenomenal.
Yeah, for sure. So let's talk about IBC and low stress trading. What is the overlap here? How do you use them in sync, or are they just totally separate things to think about?
No, because they're definitely not separate, because everything we do financially is tied to everything else we do financially. And I mean, all of your dollars, all of your capital is in one ecosystem. So when that's even true of spending. What your investment accounts and your savings accounts, they're going to be dependent on what you spend. So if you like to buy loads and loads of beefy potato chips, you have less to invest.
Yeah.
Those I hear they're really good. So Hans was we were talking about that, and they say they're phenomenal.
Yes.
But so I'm just joking around with him. But yeah, if you, I'm not calling that frivolous, but if you frivolously spend your money, you're going to have less to save. You're going to have less to invest. So every dollar in your ecosystem is tied together, whether you believe it or not. And a lot of people don't think of it. They think of it as isolated silos or buckets where, like, this is what I have to spend, this is what I have to invest. And so if this is what I have to invest and I do IBC, or I put it into whole life insurance, now I can't invest as much because everything's siloed, but they all should integrate in some way. And you have to think about the totality of your dollars. So when it comes to IBC and what we're doing with the low stress trading, for example, I'm also starting to do some other things that I'll be talking about down the road. And just to tip it off, like I did with low stress trading when I started that, this one has to do with income stacking and using amortized loans to continuously stack income. So it's another bucket of a place to bring in another cash flow engine. But all those are integrated off of IBC. So there are a couple ways to think about how you can do both. One is obviously we want to provide that protection. We want to provide the savings. We want to have a capital base. And one of the places I'm thinking about when you talk about that is this market that we're in right now, this bull market, is it going forever?
No, I mean, it sure feels like it's going to. It feels like the Fed and the Congress is going to keep spending. The Fed is going to keep backstopping them. There's no restraint or fiscal discipline here, and they're openly acknowledging that we're not going to try to deflate the balloon. Like we're not going to give the economy the medicine it needs. We're going to keep it going. We're going to keep growing it because they're valuing it. They're saying that higher equities market equals better economy, which on paper for asset owners that's true in that element of your portfolio, but it's not. It's not a healthy economy, and so it doesn't feel like it right now. And typically that's when we should be the most nervous. But again, I having done 5 straight years of deep diving into macro and reading everything I can, spending all of my free time learning about economics and finance. Um, I it's felt that entire time, particularly since the fake pandemic, it's felt like the bottom's about to fall out. And so you can really get sucked into like I need to be just hoarding and saving up canned goods and bullets, and like you can really get sucked into that. But in reality, I don't think that's going to be the case, and I think that it's safe to assume they're going to keep trying their best to keep everything growing and inflating. Asset price inflation is what they want, even though Anthony Papliano makes a great case for deflation right now. And again, this goes back to the episode from 2 weeks ago where we said both of these things are true. The case for deflation and the fact that like jobs are going to continue to be lost while productivity and profits continue to rise, but there's a lot of deflationary factors at play that are kind of that seem to me to be more reflective of the actual economic situation for most Americans. And that's they're dreading deflation, right? But we've also got all of the moves, all the monetary and fiscal policy align to keep pumping up the asset price. And so it is important in our view, protect, save, grow. None of these, even though we have an order of operations, I don't think that means that even though growth is our third of three in the order of operations, it doesn't mean it's not important towards an overall strategy. It's just one can be outdone if the previous ones aren't in order, right? And so we have this order, but they're all equally important. So grow with low stress options is our best vehicle that we found to generate more dollars. And protect and save with IBC. So I think that these two together are kind of the perfect recipe for making sure that you've got your boat patched, as we say. You're hedging against a lot of things that could derail your growth, but you're also hitching your wagon to the most profitable, consistent growth strategy that we found.
So the short answer is no. You don't think that we're going to be on a bull run forever, or you do?
I don't think we're going to be on a bull run forever, but it's hard. It's very hard to say when that might happen because again, it feels like it could be tomorrow with all of these things that make us feel like we're on the precipice, like we're on the verge of this major economic crisis. But at the same time, it's felt like that for so long that you just get lulled into, well, I guess it's not coming, right? And so I guess so. Short answer is I don't know, and I'm going to be
Yeah.
ready for both. Is the plan?
Well, what I do know is that over time the stock market has gone through cycles of tanking, right?
Yeah.
Yeah. So do you think that's going to happen again at some time? There's going to be a big drawback, big pullback?
Yes.
I think so.
Yes.
And I also think that even, we're doing this low stress trading. We're really excited about it. We've been doing it in a bull market, but the conservative nature of my mind is that when that happens, this is going to be harder. And getting 1% is going to be harder. But have one of the strategies that I am also somewhat relying on is I keep a pool of capital in my policies for two things, for emergencies and opportunities. And then from there, like those opportunities can even include spending, for example. Um, whenever I need to buy a vehicle, because we always go back and talk about that. But one of those opportunities is going to be the next drawback. And if you watch those curves historically, the market tanks and sometimes it levels a little bit and people jump in and it tanks further. But there's usually like a 3 to 4 month period where the bottom is starts to become more and more obvious because it just stays flat after the tank, maybe with some small jumps, but it gets relatively flat. And if you are properly, so you can be in two places. You can have all of your money into something like what we're doing trading, and if it drops at an extremely high level like it did in 2008, it's going to be hard. I think that what we're doing will get us out of it more profitable and better, but you're going to have to be patient and you're going to have to see it being more of a challenging scenario. But if you can hit that bottom and you're well capitalized because you've actually saved money methodically and because your savings equals premium and you have a pool of capital ready to take an opportunity, there is no better opportunity than buying at the bottom. Everybody knows that and nobody does it. But
Hmm.
if you're prepared, that's one of the places that I'm going to have capital on the sideline because when that happens, and it's going to happen someday, I'm going to drop a very large amount in there and I'm going to explode profits on the way back up.
Yeah.
Yeah. So that's just one place that these two can integrate. And I have that pool of capital ready for any other opportunities that come or for any other spending I need. You name it. Like it's ready. It's in the emergency opportunity fund. The
Yeah.
second place they integrate, which I actually want to draw out here whenever we get to it, is using them in tandem while you're trading. But what are your thoughts on how they integrate?
Yeah. So I'll tell you what I do, and this might get into what you were alluding to. If we've convinced you that having a proper protection and savings asset foundation in place via IBC, in our opinion, and having a growth strategy in place, and we don't just do low stress trading. We have rental properties. I'm loving silver right now. I'm loving my gold right now. I'm really liking crypto right now. So it's not just that we're in this, but this is as far as the non-hard asset, like non-metals, non-rentals, non-crypto, for me, my equity exposure is almost entirely in LSO right now. And I'm very comfortable with that. So if we've made the case that you should be doing both of these things, here's how I do it myself. Is I have basically used my cash value and the way that we do our family bank is my policy. I use that cash value. It's earmarked, not officially, but in my mind, in my spreadsheet, my policy is meant to be borrowed out to grow and invest with, right? And my wife's policy is to not be touched and to that's our emergency fund, right? Trying to build up towards 1 year of income, currently at about 9 months right now. But once that gets to at least 1 year of income, maybe I would consider touching it. But right now, that is going to be if I don't make a dime from Remnant Finance for a year, that is going to be what we live off of. And so that's my savings. It's all both of those are also protection, obviously, because they're our life insurance policies, but that's my savings. Now, what I do with my policy, and again, if you just have one policy, I would not recommend just leveraging it to the max in order to invest, because that inhibits the savings element that you might have with your policy. But because I have a totally separate policy that is my emergency fund, I don't really feel the need to keep too much cash value available in my policy. Now, I do keep a cushion, and I'll just put numbers on it. Right now, I have about $135,000 of cash value in my policy, and I have about $120,000 policy loan outstanding. I keep about 15 in there because what if my rentals are vacant for a few months? What if I have major expenses? Like, I'm not just going to max it out. The company will let you borrow about 97%, but I'm not going to do that. I'm going to keep about 15 grand in there as my current number right now. But over that, I just paid a premium in November. And so that premium increased my cash value by the amount that I paid in PUA, by my dividend, and my base did a little bit because it's 4 years in. And so I said, okay, well, I still want to keep about 15 grand in there, but I got some more room, so I'm going to borrow that and put it into low stress trading. That $120,000 outstanding policy loan that I have is generating interest, but it's also the source of funding for 3 rental properties in my trading portfolio, or not my whole trading portfolio, but part of it. So I took out a policy loan with the new cash value available that I had. I put that into low stress trading, and I'm now trading that. Now, I don't have, now again, if you read Nelson Nash, we want to have a plan to pay this back. Why would we treat our money differently than we would treat the bank's money? But I'll caveat that the bank would never offer me a loan where I have no obligation to repay, where the only term that they set is the interest rate, and where all payments go to principal only because they're not amortized over principal and interest. Also, the compounds once a year instead of monthly. Like if Chase Bank offered me a loan on the exact same terms that Lafayette Life does, well, then I would treat my capital from Chase Bank the same way I'm treating it from Lafayette. So it's not like it's a different conversation when we're talking about buying a car. In that case, yes, I'm going to make diligent repayments on that because that's not producing anything for me. But if Chase Bank gave me a loan with the exact same terms and I could go and invest that and make 1% a month, or sorry, 1% a week in low stress trading, well, in that case, I would be doing what I'm doing right now. And what I'm currently doing is I'm opting to make this a interest only loan for myself. So every month I go in, I look at how much interest has accumulated over my $120,000 target, and I pay down that loan just to knock off that interest, right? So I always know I have a predictable cost of capital each month or each year. The way that interest policy loans interest grows, it doesn't matter if I pay off annually or monthly; it's going to be the same. But I choose to do it monthly. So every month I log in, I say, all right, there's 120,000 and $600. Well, I'm going to pay the $600, and I consider that my cost of capital. That's my carrying cost in order to leave that 120 working for me in the rental properties and in trading. If I paid that down right now, if I set a loan repayment plan for myself and pay down that principal, well, that would be good in that in the sense of repaying a loan. But then I'd be like, well, I want that capital out working for me in options because it's doing so much more. And so again, because I've got the protection and savings component already, hammered out, and the fact that I'm not touching my wife's policy, which is our emergency fund, I feel comfortable leaving this loan outstanding and just making it interest only for myself. Now that might change down the road, but that's what I'm currently doing. I also did the same thing with my daughter's policy. I took out a $10,000 policy loan against one of their policies, and I opened a Schwab trading account in their name. It's called Lena and Talia. That's the name of the account on my Schwab homepage. So I put $10,000 into there. I'm not putting anything else into it, but that currently is at 11.3 thousand, and the policy loan is at 10.3, right? And that's just in the course of 2 months. So I've made $1,000 more on a $10,000 policy loan in the course of 2 months. Above, I've made more than that, but over the interest rate that I've accumulated, I've made $1,000 on top of that on a $10,000 loan. So if you were to graph this, it's like the loan interest rate is growing slowly, and the trading account is just skyrocketing relative to that. And so the same thing there. I'm going to log in at the end of the year on that one, and I'm going to pay down the interest to keep it at 10,000. I'm just going to keep that 10,000 working for them and growing indefinitely until we need it for either child related expenses, if they need a car down the road, right? So I'm trading this on their behalf for their use in the future. But that's the summary, is basically the way that I'm integrating the two is I'm taking cash value, I'm using it to trade with, and I am choosing to pay down the interest to keep my principal static.
Got it. Yeah. So let's check this out real quick. Let's do some math. I will share a screen for those that are watching on YouTube. You will be able to see this. For those that are listening, we'll talk through it. Okay, cool. All right. So I'm going to draw on this whiteboard here, and then I'm going to open up a couple things. So first, I took a screenshot and said, let's just say you're doing a $50,000 loan. That's right here. So we got a $50,000 loan. This is compounding at 1% per week, which is what almost everybody that we've brought in and most people in the community, Hans and I, everybody's for the most part averaging more than that per week. But so let's just use 1% weekly return, $50,000 a year. This is going to be in the form of a policy loan. So 0 is the amount that we're going to add extra. At the end of year 1, that 50,000 would compound to just under 84,000, 83,884. And if we just follow that down through years 2, 3, 4, and 5, you end up with $664,000 and $664,549. Now, I'm going to pull that off of here, and I'm going to show on this screen what that might look like in reality. So we took we said $50,000 loan, and in 5 years, compounding at 1%. There we go. All right. Top of the screen, it doesn't like. Compounding at 1% weekly. That that came out to 664,549. How would I use IBC then? Because it's not as straightforward as that, is it?
No.
All right. So in year 1, I plug in 50,000. I'm going to compound at 1% per week. That's going to come out to, and I've got that ready. I'm actually not going to show it simply because I got the calculator on another screen. I'll write out the pertinent details. All right. So if I plug 50,000 in year 1, sorry, I wrote the wrong column, $83,884. But we're going to have a tax on that, right?
Yep.
Do you have a calculator handy? Or I can even bust out a calculator here and overlay that on the screen. So let's just use from the gain on that 83,884 minus 50,000, which is 33,884. I'd rather show this actually. So if this is hard to see, I'll talk through it at the same time. Let me pull this basic calculator over here. Unfortunately, you can't make the calculator bigger. So, all right, so we got 50,000 minus 83. I did that backwards, didn't I? 83,844 minus 50,000. That means you profited $33,844. But let's say we got to pay 20% tax on that. So I'm going to do times 0.8. So that's going to be my net profit. I'll write that underneath. So $27,075 profit after we pay taxes on that gain. But you got a policy loan off this $50,000 loan. If it's at 5%, what is my interest rate every year on that? My interest charge. So if I wait to the end of the year, the company's going to charge me $2,500 in interest. So we'll subtract that from the $25,000 as well. I'm going to do it backwards on the calculator. So that means at the end of this year, I've made a profit of $24,575. So using your policy loan, not paying the principal down, was it worth paying $2,500 in interest to earn after taxes $24,575?
Yes, that's a 10x.
You're technically using other people's money, right? Because we borrowed the insurance company's money. What's our money doing?
Growing and compounding uninterrupted.
It's still growing and compounding uninterrupted. So off of somebody else's money, we had to pay $2,500 in interest, and we earned $25,000 almost. So like you said, that's a huge gain. That's what is that, 1,000% gain?
Yeah, about 900 when you back out the initial 25, but yeah.
Yeah, so I'll do this a little faster. That was to step through what it looks like. So we're starting year 2. This is year 1. We're starting year 2 then with 74,575 to compound. So that comes out to $125,000. I'm not going to actually put that on the screen this time to save the time. 125, 113. Take away the initial principal, which is now 75,575. Pay for the taxes. We're just going to use 20%. I could do 25%. It doesn't matter because there's so much profit. 40,430, but we once again, remember it's the end of the next year, we've got to pay the interest. So we're going to pay $2,500 again. So we made $38,000 in year 2 off of $2,500 in interest after taxes. Add that to what we started with at the end of year 2, we have $112,505. And if I just keep doing an iteration of that,
Yeah.
yeah, so every year we do the same thing. This time that $112,000, starting off year 3, I'm only going to do this for a couple years to show how much this makes sense. We're starting with 112,505 in year 3, doing the exact same thing, plugging that into the calculator here. It ends at 188. So I'm going to do a negative sign here. It ends in gross profit, 188,748 times 0.8 for the taxes minus 2,500. You profited $58,500 off of a $2,500 loan. So once again, we're just going to add that for the principal. Remember, that's after tax profit here if the trading goes well. So in year 3, you're 50,000 after taxes, after paying the interest, your $50,000 is still growing in your policy, still providing protection for your family. All you did was save it first and have it in that location. Now, using this number, $170,999 in year 4, keep going with this. 170, we're starting with 179.99. That comes out to 286,883 compounded. So we're almost done here. I know it's starting to get repetitive, but I want to show a 5-year process of why this makes total sense. You could go longer if it's going well, and it's only going to get easier and better. All right, take the taxes out. Once again, $2,500. In the 4th year, you made $90,000 on top of everything, right? And so far, it's cost you 10 grand to make all this profit total. The summation is 10 grand. In 4 years, your balance of your account is $261,206. How's your insurance policy look? What's the cash value you've been doing this whole time?
Growing uninterrupted.
It's still growing, and you still have a death benefit for your family in the event that you die, right? Because this probably isn't going to cover your family's expenses, is it?
No, not yet.
But your policy does have
Policy
hundreds of thousands, if not millions of dollars in death benefit. So we've provided them. All right. The final iteration of this, 261,206, that grows in the final year, gross to 438,222. Now, the calculator that you can get on LST doesn't show the taxes, which is why I'm slowly stepping through this. We're going to pay 20% on taxes, and then we're going to subtract 2,500. For in the 5th year, your profit is $139,000 after taxes, after paying the premium. Your account balance then is now $400,000, 318. Now let me ask you this: did you like making $139,000 in profit?
I very much like that. Yeah.
How important is it to you that you make more profit just one time in your life? Like, what if you kind of just maintained that profit one time? Would you be good with making 139 again next year?
Absolutely. Yeah.
All right. So now after 5 years, if I took out of that $400,000, $50,000 to just pay off the policy loan in one fell swoop, I'm still starting year 6 at $350,000 after paying off the policy loan. So it's going to still do better than it did the year prior because I'm starting with 90,000 more. So I'm actually going to make more than 139,000. I'm going to have it's not going to be growing on the exact same curve, but now I can be made whole in every place. Now that $50,000 back in my policy for maybe a different investment, a different expense, anything else that comes, bigger emergency fund, whatever you want to name it. You only have to do it once and have the patience of letting it sit as what people think of as a loan that they have to pay back for 5 years, only paying the interest from the or from the money they're making in their investment. So this is why using these in tandem, starting with 50,000, paying the taxes, paying the interest in 5 years is worth $400,000. and you did it on somebody else's money because your money was protected and growing the whole entire time.
Yep.
It's
Now
phenomenal.
you
You put those two together, these are the actual numbers that would work out to using 20% interest. What I can't predict is that you will always get 1% per week. But
right.
what if we have a down year in the market and you don't get 1% per week for a year or two? Can you just wait 2 more years to pay the policy off?
Yep. Yep. Full control.
You have full control. It is so powerful to put these two together. And the whole entire time, your capital grew in your policy. You provided a death benefit for your family, and that $50,000 is available again to deploy any other way you want, or just leave it there. Keep doing that. It's up to you. But be at least a good enough banker to pay the interest every year. And I mean, like I said, both boats rise, because if that 50% was left in there, and let's say that your policy is mature enough that it's compounding at least, let's just use 4% per year. Does that work? 50,000 compounded at 4% per year is over 5 years, it's now worth 61,000. So you have 61,000 in your policy based on that initial 50 grand. If it was doing 4%, I just had to pick a number. You have 600 or whatever it was, $400,000 in your growth account, and you have all 50,000 in principal, original principal back.
Yeah.
It's phenomenal. Like, nowhere else can you have that happen in two sides of the equation.
And you have to make some assumptions there. So let's
Yeah.
steel man the inevitable. It's because we deal with whole life, people instantly jump to a scam, right? That's a retarded way of thinking based on people that don't understand what they're talking about, but that's always where people jump to. Now, we let's make their argument as strong as possible. Let's max out the policy loan interest rate. 8%. You can't go higher than that. Contractually, that's your maximum, right? So
Yeah.
call it an 8%. Now let's max out taxes. I mean, realistically, you can make a lot of money and pay in the 22 to 25% like net tax. That's a very healthy assumption to make. Like 25% might be a little more conservative, but let's say 30. Bump it up to 30, bump the interest rate on the loan up to 8%. Um, and then what I do on my spreadsheet, because I build out my spreadsheet that takes into account a lot more stuff, like you showed initially on that website just shows you if you make 1% a week and these are your contributions and your starting balance, here's those returns, right? It doesn't account for taxes. Are those taxes coming from elsewhere? Because if they come from elsewhere, you don't have to deduct that balance from your trading account. But being as conservative as possible, we're going to assume that we're going to withdraw from the trading account to pay the taxes. So let's make all these assumptions in here. When I plan for the future, when I'm looking at like, all right, at this age, we want to make this move to New Hampshire. Where's my, I always use a 0.8% average weekly return. Now I'm averaging about 1.4% in this account, weekly average rate of return, right? But I plan for 0.8%. What if I fall 20% short of my target, which I'm currently exceeding by 40%, right? So like how when we have these conversations, when we have these challenges, we say, okay, what would you call a good what are you happy with on your investment portfolio, right? And like 10%, people are happy with like a 10% return, right? Well, how high would we have to dial down, or how high would we have to dial up the taxes and dial down the weekly returns that we're earning in these portfolios to get a 10% rate of return? I mean, you have to assume like 50% tax rate and like a point, I don't even know, like a tenth of our target return, like 0.01% a week. Like you'd have to dial this down so comically low relative to what we're all currently experiencing, um, to even get close to the performance of say a 10% return on your and that like in your typical stock portfolio, that's a fantastic return. But again, like paradigms are changing, old notions are shattering as like we go through this economic shift. And so that you need to throw that out the window that, this is what I'm constrained to, because you don't need to be constrained to that anymore. And so you have to make, even if we make the most generous assumptions to the argument someone would make against this, we still blow your 10% return out of the water. Um, and so let's go now to what if I'm doing both of these things. A conversation I just had with a client today was, okay, cool. I've got my trading account set up. I just started. I'm starting the 10K challenge. Um, I want to fund my account more, but I also want to pay PUA. I'm paying my premium right now, but I need to add more to my PUA rider. What's the order I should do this in? Should I trade the money and then use those earnings to fund PUA, or should I pay my premium, pay the PUA premium, and then you borrow that to trade with? Now, I think you just made a great case for the latter. PUA first, borrow it, and then trade with it. Because if you do it in the reverse order, one, you're risking some protection, right? Every dollar that goes into your IBC policy is protecting your family. It's getting all these, capturing all these tax benefits. And if you don't live for long enough for you to realize those big returns we're talking about, you've optimized the protection first. Um, but also, if you go the other direction and you start with, not only are you paying the taxes, so in your calculations there, you're backing out the taxes, you're backing out your policy loan interest at a minimum, and then you're giving those numbers, and they're impressive. But then if you further withdraw and erode those gains in order to pay premium, I think that is less efficient than letting what we want is for as much of that money that's growing in our LSO account at 1% a week or whatever we're getting. We want as much of that to be untouched as possible because that's how we get larger and larger returns down the road. So I want as few of those dollars going to tax as possible, and I want as few of those dollars going to interest on my policy loan as possible. I certainly don't want to be withdrawing enormous chunks of that in order to pay premium, because to me the premium is then just go the PUA is just going to go right back into my trading. And so I think that that's an inefficient way to do it. I fall firmly without any, I can't think of a scenario where I would do it in the other direction. I would always fund my PUA first and then borrow against that. I think that's safer and more efficient on all counts. What do you think?
Yeah, I agree when you're starting this. If you get into something like this and you're 10 years deep and your monthly income from trading is tens of thousands of dollars, I could see doing it either way, but I think that your way is absolutely the most efficient way when you're starting this whole process, because you start compounding 1% per week when you have a very large seven-figure account. It's a lot of money. You could definitely be like, hey, I want to provide some protection. I'm going to use some of this to buy a policy. But in the starting phases of building that compounding, 100% save, protect, save, grow, save it in the policy first, get it compounding. That's going to be more optimum. And I think, yeah, I'm with you 100% of the time, all the way
Yeah.
up until you're compounding on millions. Like you could be like, hey, I want to allocate 10 grand of this to, or, 10 grand of this $60,000 a month I'm making to policies. I could, I can't say that's dumb at that point, but you have to get there, and you're not going to get there overnight.
You get to rewrite a lot of the rules, I
Yeah.
think, that got you to that level when you get there. I think you get to reevaluate a lot of your order of operations because it's like, you know, at that point, you're very likely very fully insured and protected, right? And so we don't have a lot of these elements that I'm going to challenge you on right now. If you're saying I'm going to start LSO first and then fund a policy with it, a lot of the things that I would challenge you on are already buttoned up and taken care of when you're at that point where your policy or your trading account is that large. So you get to eliminate a lot of the factors that indicate that you should start with premium first, in my opinion. And you could change your criteria there, and that kind of gets into the final thing, which we've sort of covered across this entire thing, is, well, why would I do IBC at all when I could just do LSO? And again, that gets into the proper order of operations. You, at a minimum, if you're going to do that, you need to get your term policy in place to put the protection there in case, because yeah, those numbers are amazing. If you make it 5 years, those are incredible numbers to be continuing to make, right? But if you've only got a year left, that doesn't really move the needle too much for your wife. And so at least have convertible term that you can, if you're going to go in this opposite direction, in my opinion, get convertible terms so that when you start making these premium, getting these large returns on your trading portfolio, you can then convert that term into permanent coverage, get an IPC policy funded by your trading account now. So I guess that's the same thing. The further you get down the road, I think you get more leeway to responsibly choose which path you're going to take first, and then which one's going to cover which, essentially. But
Yeah.
in the beginning, all of our clients have been doing this for 4 months or less. We know that because we're the ones who introduced the trading to them, right? Um, and then all of our clients, I mean, some of I get there's a handful, I suppose, that have known about IBC and been doing it longer than we have. But for the most parts, they're all our new clients, and so we know they've been doing IBC for 4 years or less. For the most part, you've got some clients that are longer than our working relationship, but in general, I think that is the proper order of operations. I believe you should fund uh, your policies first. I currently, like I said, on my investment, the policy that I use for investing, when I have cash value above my buffer, I do put that into trading. Um, but also when I get paid, I don't put every dollar that I make into premium. I also don't put every dollar into low stress trading. Like a portion when I get paid, 10% of that goes into investments. Right now, that's mostly low stress trading, but it's also buying Bitcoin and metals. Um, and so that 10%, I try to get at least $400 a week into trading, and then I either put the rest into trading or I put the rest into another investment. But that's going in there directly. It's bypassing going into premium. But I'm also funding the premium, right? And so if you're at a point where like only going to do one or the other, I think you should do IBC first because I think that's a proper and responsible order.
Yeah, agreed. I will always pay my full premium before I'll worry about getting money into the brokerage. But since you asked, I crunched those numbers real quick while you were talking. I could do it faster without walking through it. A $50,000 loan at 8% is $4,000 of interest per year. Compounding at only 0.8% weekly in the trading account, and a 30% annual tax. Eventually, you could get up to 37%, but we're not talking about that tax bracket yet. So let's do this worst case scenario. Start with $50,000. In the first year, you profit almost $14,000. Was that worth it off of a $4,000 expense?
Yep.
Still a 300% return, right?
Yep.
And this is after paying the 4,000 back. Year two, your total account balance, assuming all those things above, is about 83,000, and you profited that year about 19,000. In year three, you have approximately 109,000 in your account, and you've profited about 26,000 that year. Year four, $144,000 in your account, profiting approximately 35,000 that year. And in the fifth year, you would have exactly $191,544 with these assumptions, profiting for the year 47,694. So if we really, constrain the parameters around this, is it still worth it?
Very much so.
Maximum interest
Very, very
rate,
much so.
reduced compounding, very high taxes, and you still now, would I take the $50,000 out of that 191 in the same year and send it back? I might wait 2 more years, but I'm in control because I'm the banker. I can pay that principal back when I want. So I might go 7 years before I pay back the principal to my policy. That's the difference. It's not it's not a 5 year timeline where I have to. I get to choose that. So yeah, it is still powerful. I mean, you're gonna hold your money in there to compound a little longer if everything was worse. It
And just looking at those numbers, that's a 31% annual rate of return. You assume the max possible, the absolute worst case scenario in loan interest. You assumed not the absolute worst case tax bracket, but like for new dollars
oh
coming in, like 30% is a very likely maximum for most people. And then 0.8% weekly return, that seems high to people in your typical stock investing mindset. But again, we're all doing well over 1%, and so that's a very conservative trimming down of what we're currently experiencing. And that's through recently through a pretty sustained down market. I mean, of course, sustained over the course of like within a 4 month window, a decent chunk of that 4 month time frame has been a down market. Um, at least for a lot of the positions we've been trading, and it's still working. So that making those very harsh assumptions, we get a 31% annual rate of return. And so we'd
yeah.
have to dial those even higher, like maximum possible tax and lower our assumption of weekly returns a lot lower to get to your 10% rate of return. The numbers here are very, very compelling. And here's the thing. We're going to address. I've compiled some comments that we've gotten from our actual clients who are trading this because when we were presenting this, we did a pretty hard press. We were like, guys, a lot of you guys are clients, a lot of you guys aren't. A lot of you guys hear the word whole life and think that we're scamming. We're scamming everyone here. But like 100 dudes in here have vetted this themselves, and they've all gone through the education process, understand their policies, and are using them well. Like, you're wrong on that, but a lot of people think that. So when we started introducing low stress trading, some people were like, "Oh, you shouldn't. Why are you paying?" One guy said, "Why you would pay $1,000 for options trading? Like, I can just teach you that for free." Or, "There's a lot of free courses out there. Why would you do that?" So we kind of joke now, like, "Oh man, like the common theme is like, this is such a good scam. I love getting scammed, right?" But here's the thing: if we were telling you, "Hey, if you guys sign up for this training and start doing these trades, it's all going to go into some other account, and then you rely on Troy, who started low stress trading, or you rely on us to pay you out and we'll pay you out," right? Then you'd be like, wait a second, there's something going on behind the scenes here. But when you start trading, when I start my account, I'm trading with Charles Schwab. And when I sell a contract, I get the premium deposited to my Schwab account. Troy, John, the team at Low Stress Trading, you who referred me, anybody else that I've referred, there's no such thing as like downlines or behind the scenes trading or anything like that. It's your individual account on your social security number with Charles Schwab or Robinhood. You're making the trade and you see the premium deposited directly to your account, and then you trade with that. There's no scam, because there can't be, because unless like you think trading with Robinhood is equally as scammy, like when you buy a stock with Robinhood, that's actually more convoluted due to their business model than it is with Schwab, and then than it is with low stress trading. Low stress trading is teaching you a strategy and helping you track it, but it's not placing trades for you. You're placing the trades and you're getting the money to your account, right? And so it's not it's dumb to even like present this as a scam, but like I really want people to, if you're hesitant, you're thinking like, oh, am I investing money with Brian and Hans? Like, who's this Troy guy? You're not investing with either of us. If you sign up using our link, or anyone who's trading, who's doing this, you can get an affiliate link, and then you can get a percentage of their buy-in fee, right? So now it's $2,000. We pushed people heavily because it was $1,000 to join, and now it's 2,000. So before that deadline where the price doubled, we were like, hey guys, you really should try this out for $1,000. Like, everyone who's been doing it has made that back in no time. So we
Yeah,
had a pretty heavy push.
and from our side, like where people, I've actually had people that don't like the fact that you can make an affiliate commission, which is just absolutely stupid. Because sure, pay 2,000 straight up, and just the company is winning alone, rather than helping the people that are your friends that are introducing you to this. Like, you don't
Yeah.
get a discount by not by their choice to pay people to bring in good people. So it's absolutely silly, and you should do it too. Like, if you're in there, you have opportunities for affiliate commissions, you should use them. It helps everybody involved. But let's read a couple of these. The third one's my favorite. So yeah, you could start. Like, what the people have told us.
Yeah. Let's see. So we've got we got a bunch of there's a show on screen on stream function here. Let's see if I can do that. Oh, here we go. You can see it. I'm at 15% profit from premium in 2.5 months. Now these are all going to show us from me because I typed them in the chat, but they're from actual clients in our group of people that we know. Like, we could call them on the phone. Like, they're real people that are actually trading. Between the 8 accounts I trade weekly for myself and extended family. Oh, come back on screen. I'm trading almost $700,000 weekly. The numbers are becoming eye popping. I got scammed. All right, you take this one.
Best scam I've ever been a part of. Thank you for pushing through the flack in the bar chat to bring attention to LSO. I came here looking for a side hustle, and now it almost feels like it popped off. It almost feels like being a pilot is my side hustle.
Yeah. All right, here's another one.
This week was my sixth trading week. I funded the account with a rental home sale. The last year, I made roughly $9,000 income from the rental. In 6 weeks, with only half the account funded, I crossed the yearly income level from the rental house at 9.7 thousand. I'm so disappointed that I got scammed by you guys.
Let's see, here we go. I started trading on October 20th and just finished making my first 1,000. You guys are such scammers. LSO is a scam. The $15,000 I've made in less than 2 months is totally negated by the $1,000 fee I had to pay, not to mention the fact that Brian got a cut. Even worse. It's like, it's just so, I mean, it's like silly as the most like
Yeah.
polite word for
And the
that. It's
best
just
part
dumb.
about that is it's you actually read it wrong. It says LSO is also a scam, and that's because of in
Oh
our
yeah.
main chat the people who think that IBC is a scam. So that was
Yeah.
what that meant, which is awesome.
There's 25. Go ahead.
$25,000 in about 12 weeks. if I stay consistent with these numbers, it will replace my income as an 11-year O3, which is a rank for those that aren't military. If probably a captain or I just forgot, what is it in the Navy?
Lieutenant for in the Navy.
Yeah, lieutenant. So, and it's a pretty good income. They do well.
Yeah. Let's see here. It's just so, it's like, it's just dumb. Calculated my LSO to fully fund the entirety of my IBC premium throughout the year and still grow my brokerage account. We dubbed it our perpetual premium paying pump. And that's only accounting for 1% a week, which I'm currently outpacing by a lot. We've got
Yeah, just some
66,000
short
in
ones.
16
Yeah.
weeks. 42.
42,000 since mid-November, according to Troy's website. That person started with a really large push, but they're doing great. Excuse me, 7,000 total in 9 weeks, 1.39% average rate of return over those 9 weeks. Go ahead.
I think the technical term is crushing it. Well done, sir. That was in response to one of the guys. But these are like actual dudes that are our clients that are currently chatting and telling us. I just said, hey, send me what you guys are working with, and of course, like one guy's making 66,000, one's making 42, one's making 7. These are all in less than 3 months.
He
But
made one. It all depends on how you start, but he made
right,
$1,000 he wouldn't have made otherwise.
right, and those, yeah, and like we have people with giant accounts trading 700 grand worth of accounts, and we have guys starting with 5,000 in the brokerage or something like that. And so, but if you looked at if we did all of these instead of dollar amounts and we just set them in percentage terms, they'd all be over 1% average rate of return per week, guaranteed. I'm currently looking at on if I look at my primary growth account, and I know the numbers because I had this conversation with a client this morning. I've put 56,000 in over the course of the last 4 months. That's in different amounts each week, and that has made 13,000 on 56. Right, so that's about a 25% return in 4 months.
Yeah,
that's wild, right? And then the same thing with my daughter's account. I put 10,000 in. I'm at 11.3, and that's the one that's funded totally by policy loans. But all 6 of the accounts I'm trading are averaging well over 1% a week. You now, if you listened to us before and waited, the cost to entry has doubled. But I would pay. I mean, if they were like, "Hey, emergency, you all have to pay 10 grand to stay in," like no brainer for me. But really, it's like I already have the knowledge, so I wouldn't necessarily need to. But to me, it's totally worth it because the tools that they provide and the ongoing continuous training, it is the easiest no brainer of all no brainers I've ever put my brain on.
Yeah, it's just because they're just an education company, the folks at Low Stress Trading. So that's all they're doing is they're teaching this. And the people that refuted our claims that this was worthwhile, who thought it was a scam, they're actually right. You can go to books, you can watch YouTube, you can do all that stuff, but then why haven't you?
Mm-hmm.
You know, and that's the question is, and not only that, but like, are the people who have written a book about it, can they may have a large group of people that are very successful where they actually learned it. I don't know. But how do you suss through the noise? And have they built an actual framework that is working for pretty much everybody who's doing it? So you're going to get a very systematic education in a community where you can continue to learn from lots of other people with lots of additional tools, phenomenal software, better software coming our way through that. Like it was worth every penny. And not only that, but I was ready to trade in 2 weeks.
Right.
From the time I joined. So if I'm going to go through YouTube, first I got to vet that guy, make sure he's good. If you vetted us already, well, we vetted these people. So you can kind of bypass like to these people that they're using. I wouldn't recommend this, which is why I traded it for a few months before I brought it to anybody, because I'm not willing to put your money at risk in something I haven't put my money at risk at, if and not knowing whether it's a good program and it's going to work. Like I wanted to vet them first. So that's why. So I traded this before I introduced it to anybody besides Hans. He was the only one that I was like, "Hey, I don't care about your money, asshole. Go put some in there." But everybody else, all of our clients, it was like, I'm not asking anybody else to do something that I wasn't feeling extremely high confidence level in what they're teaching, and so, yeah, if you believe, if you're listening to this, you could vet them yourself as well. It's going to cost you $2,000 to do it now. But it's so worth it. Like you said, dude, if knowing what I know, I'd pay $10,000 to join. It would have just taken me longer to get the money back, but it would still, in the thinking long term, been worth every single not even copper, zinc penny that they have to offer. We don't make pennies anymore. Every single shiny nickel.
Yeah.
Yeah, it's a phenomenal group. And if you're interested in that, we'll have the link below. Join through our link. It's remnantfinance.com/options. We'll link it in the description. If you're getting value from this, please, I don't know. I'm sorry. I don't know if you had anything else to say, Hans, but
No, that's
if
it.
you're getting value from this, please subscribe to it. Please share this podcast, especially if you believe in what we're doing with LST. This is a pretty good discussion where we kind of broke down some very conservative numbers with IBC. We share it, do it, join low stress trading. It's awesome.
Yeah. That's all. Yeah. Can't beat that.
Yeah.
That's
all right.
it.
Have a good one, man. We'll talk next week.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
This is Brian and Hans signing off.